So our options trading desk here at SMB is made up primarily of specialized options traders who execute monthly index option strategies. And essentially our traders are measured by how they perform over 12 monthly options trading cycles. This is in pretty sharp contrast to the day traders on our trading floor here, who are in some cases in and out of dozens of stocks each day. In other words, it takes our options income traders, in most cases, a year to complete 12 trades, when for many day traders, they're in and out of 12 trades in a day. Now, there are some options income traders who are involved in these longer term, slower moving monthly strategies who would like to find a simple rules-based weekly option strategy that requires very little management but would provide as many as 52 bites at the apple a year instead of the 12 that they're used to. Well, there's an options income strategy known as the broken wing butterfly, which can be designed to be employed on a very short-term weekly basis and deliver outstanding results if followed carefully over time. And the cool thing about the strategy is that while it's quite reliable in normal weeks, it has what we call a kind of lottery ticket aspect where under certain circumstances, certain particular circumstances, an outside, much larger than normal result can occur. So if you'd like to learn how this simple weekly option strategy works, then I think you'll enjoy this video, so stick around. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan. We provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, you'll want to click our subscribe button right now so that you don't miss any of our free trading videos produced for the trading and investing community. Now, in this video, we're going to be reviewing the details of a broken wing butterfly strategy that was designed for the SPX index, the index which tracks the movement of the S&P 500. It's the most commonly traded and liquid of all index options products, so any online broker that you use will support the trade we're about to go over. And while we're talking about option strategies, if you'd like to learn 3 more real-world option strategies that our traders use, including the surprisingly simple and powerful strategy that some of the greatest investors in the world like Warren Buffett use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in, month out, plus an option strategy that you can enjoy with a stock that you like where you'll make your target profit, whether the stock goes up, goes nowhere, or even goes down a small percentage, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. You can also visit optionsclass.com to attend this free intensive workshop. It's an extremely rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so let's jump in. First of all, because some of you may not be familiar with how index options work, we'll do a really quick review. If you know about index options, don't worry, this will be quick and then we'll jump into the guts of the lesson. Okay, so index options differ from stock options because with stock options, if you decide to exercise a call option, for example, the one who sold you that call is required to deliver actual shares of stock that you pay for. Or if you exercise a put option, the one you bought that option from is required to buy your actual shares for the strike price of the option. But you can't go out and buy a whole index like you can buy a share of stock. So that's why with index options, the settlement is in the form of a cash payment from one party to the other. That cash payment is equal to $100 for each point that the market closes above the strike price of your option on the day that the option expires. So for an SPX call option, for example, if you have an SPX 2900 call and the market closes at 2940 on the day that that call option expires, the one you bought the call option from owes you 40 times $100 or $4,000. The opposite is true of an index put option. If you own, say, an SPX 2850 put and the SPX closes at 2840, then you are owed $1,000 because your 2850 put expired 10 points in the money. Okay, So that's the very simple way that index options work. So with that basic background, we can take a look at this weekly SPX broken wing butterfly trade. Okay, so you can see that on June 13th, when the SPX was trading at 28.89, we entered into this trade by buying 5 of the 28.30 puts, which were about 60 points below the market, and we paid $683 for each of those. And remember, each option represents $100 per point, so a $6.83 put requires a cash outlay of $683. So if you buy 5 of those, it comes to $3,415. Now, we also sold 10 of the 28.20 puts, 10 points below the ones we bought, for $556 per option. And then we skipped down 20 points to the 2800 put and bought 10 of those at a cost of $371 per option. So to review the total transaction, we sold 10 of the 28.20 puts for $55.60. We bought 5 of the 28.30 puts for $34.15, and we also bought 5 of the 28.20 puts for $18.55. So when you add all that up, you end up net actually receiving a credit of $290. Now, for this transaction, for reasons I can explain to you later, your broker will require you to set aside about $4,700 for this trade. So you should think of that $4,700 as the capital that you have in the trade, and you should think of the $290 credit we just talked about. That is your target profit on the trade. So if you do the math, the $290 target is about a 6% return on the capital that you've employed in the trade. Now, this is a weekly trade, so we close the expiring trade and roll it over to the next week every week, so we get our 52 bites at the apple potentially. Then that would be a 6% return in 7 or 8 days. Okay, so let's analyze the simplest thing that can happen with this trade, which is in fact what happened in this case that we'll show you. And in this case, the market remained above all of the options by expiration day. So let's see what happened in this case. The 28.30, 28.20, and 2800 puts all expired worthless. Why? Well, the put seller only has an obligation if the put option's in the money. In other words, if the market closed below the strike price of the put option, as we explained earlier. But in this case, the market closed above all of the options, both our long options and our short options. Thus, we just pocket the original $290 credit, scoring a 6% gain in 8 days. That's it. You made your $290, you made your 6% return. Okay, so that was a simple example. Now let's take this a step further. Suppose instead of the market closing at 29.56 as it did in this example, what if it closed at 28.25 instead? Now that gets more interesting. Remember how we got a 6% credit, $290 originally. But if the market had closed at 28.25 on the day that the options expired, let's focus on how each of these options would have settled. Well, again, the 28.20 and the 2800 options would expire worthless. Those are below the market. So those have no value either way. But the 28.30 option, that expired in the money, and thus you can cash those in for $500 a piece, or $2,500 since you bought 5 of them. But remember, you got an initial credit of $290 that you get to keep also. So your total return on that trade would have been $2,790, which is a 59% return on the utilized capital of about $4,700. So that's what we call the lottery ticket. If the market rallies, you're pretty much guaranteed your original credit. But if the market sells off towards the end of the trade into your broken wing butterfly structure, the outcome can be much greater than you would have anticipated. Now, this trade is not going to work every time. We position it far from the market in a predefined way so that the short options that we sold are at what option statisticians call the 10 delta strike, which in this case happened to be the 28.20. Your broker can teach you the settings so that you can see the delta of each option incidentally. We then buy a put 10 points above that in all cases, but the put that we buy below the market is positioned wherever it needs to be to give us a 5% return or greater. We only put the trade on if the SPX is trading above the 20-day moving average, as it was in this case. Now, like any trade, there's a scenario where this loses, and that will occur in this trade if the market sells off too early in the trade and too quickly. In that case, the options will change value, and if the short options get too pricey, we may be forced out of the trade if the combination of all the options we sold and bought add up to a loss of 10% against the capital that we've deployed in the trade. So that's our stop. But if you use the 20-day moving average as an entry indicator, we have found that the losing trades are generally infrequent. We like to enter and exit Thursday mornings, incidentally, about an hour into the cash market, unless, of course, either the 20-day moving average has been crossed or we've been pushed out of the trade earlier by a stop. Now, I'm not saying that this is the perfect rule set, by the way, but it did work extremely well over the last 12 months. We put on a trade that gave you more than a 5% credit, and you got to keep that in most scenarios where the market stays above all of the options which we transacted, which in this case were almost 60 points below the current level of the market. So here's a trade where if the market rallies, goes nowhere, or goes down modestly, you'll make your 5% return. But if the market, towards the end of the trade, sells off 60 to 70 points from the entry level of the market, the returns can be above 50% for just that 1 week. That's that lottery ticket aspect that we were talking about. I personally think that's pretty cool. So many scenarios where you can win. It's exciting, and this is a really simple strategy compared to the ones the guys on our trading desk employ, which have even more interesting characteristics. Now, just to remind you, as I said earlier, if you enjoyed this video and would like to learn 3 more real-world option strategies that our traders use, including the simple, powerful strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. It's an extremely rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Now, one more thing I'd like you to do is go ahead and click our subscribe button so you don't miss any of our trading videos produced for the trading and investment community. And while you're at it, please add your feedback in the comments section for what videos you would like us to produce next, as well as what you found helpful from this video. So from all of us here at SMB, trade well.